Okay, this is a quick intro video to the Emini-Watch website. The Emini-Watch website is all about how I use my three non-correlated indicators, better sine wave, better momentum, and better proam, to day trade E-mini futures. The key message I want you to take away from this video is this. The biggest mistake I see traders make is they have too many indicators on their charts and they're all based on price. Almost all traders are ignoring the two other primary data points. That's average trade size and buying and selling volume. And when you combine these additional data points into your analysis, you get higher probability trading signals. So instead of using multiple price-based indicators, you should be using three non-correlated indicators, one for price, one for average trade size, and one for buying and selling volume. So let's get started. One of the advantages of running a trading website like Emini-Watch is that I get to talk with lots of traders about how they trade. They send me emails with chart examples, and typically this is what a chart will look like. It's crammed with half a dozen or so price-based indicators, and I'm sure you're familiar with most of them. We've got a MACD, an RSI, a CCI, a fast stochastic, and then on the price bars themselves we got candlesticks, Bollinger Bands, a moving average, maybe even a stop and reverse trailing stop. The problem is all of these indicators are based on price, and when one goes up they all go up, when one goes down they all go down. They're all correlated. You're getting no new information by adding extra price-based indicators. You're just cluttering up your charts. What most traders are ignoring are the two other primary data points you get from the exchange: the trade size and whether the trade took place at the bid or the ask. And if you look at a typical time and sales window from a quality data feed, you'll see these extra pieces of data: trade size and what in this case TradeStation calls condition, which is the bid-ask information. Now, it wasn't so long ago these extra data points weren't available. We were lucky to get total volume traded, and that was usually delayed or only available at the end of the day. But things have changed, and particularly with trading being almost 100% electronic now, this information is now available in real time, and you should be using it. So stop missing out on 2/3 of the available information and start including this extra information. It'll improve your trading decisions, and I'll show you how I do it. Let's talk about average trade size first, and this is the better proam indicator. Professionals trade in size and amateurs trade in singles. So by looking at the average trade size, you can see when the professionals are active and when the amateurs are active. Now, you might think professionals will try to disguise their activity, and you'd be right, but there is a limit to what they can do, and despite splitting up their orders, they still can't cover their tracks entirely. So let me illustrate with this E-mini chart. The bars are colored blue when professionals are active, and they're colored yellow when the amateurs are active. And let's keep it simple and just look at the blue professional bars. You can see there's a cluster down here at the lows, and that's where the professionals have their resting buy orders, waiting for the market to come down to meet their target entry point. Then the market rallies a little bit here and then sells off again. And again you can see the professionals active at the lows, buying in anticipation of this change in trend. Now there's a lot more to this chart, like interpreting the amateur bars and what the professionals are doing up here. But let's just focus on this one turning point. Hopefully what you can see is that by using an indicator that measures average trade size, you can identify professional activity and follow the smart money. Now the next indicator is better momentum, and that's based on volume traded at the bid or the ask. Remember, volume is the fuel that drives price, so better momentum is measuring this buying and selling volume and effectively measuring demand and supply. Traditional momentum indicators are based on price. Better momentum is different, and it uses the volume data instead, and that gives you better signals. And to illustrate, I'm going to use the exact same E-mini chart and focus again on this turning points. So the first thing you need to know is that all markets turn with a repeatable pattern, and it goes like this. First we get exhaustion, then divergence, and then finally a flush signal. First you need exhaustion volume, where you get a climactic amount of selling in this case, and that generates this blue dot. Then as the market continues down, you need less selling, the selling to subside. Fewer sellers tells us that almost all the sellers have sold, and as price continues down it generates a divergent signal, shown with the red dot here. We need a final gasp of selling where all the amateurs have finally given up and capitulated, and that generates what I call a flush pattern here, flushing out the last of the sellers, and that's shown with a yellow dot down at the bottom of the chart. So better momentum gives us these three signals. They're all plotted in real time, there's no back plotting, and it gives you a feel for the demand and supply picture. At this turning point, all the sellers have sold, there's no one else to sell, and that's the right condition for a market to start to rally and to trend in the other direction. So a volume-based momentum indicator will help you identify these market tops and market bottoms. Lastly, I'm going to talk about beta sine wave. It's my only price-based indicator. The problem with traditional price-based indicators is that they either work in a ranging market when price is caught between support and resistance, or they work in a trending market when price is strongly moving higher or lower. Traditional price-based indicators don't work in both types of markets. So for example, oscillators like stochastics work well when the market is ranging, but work horribly when the market starts to trend. On the other hand, moving averages, like an exponential moving average, works great when the market is in a trend, but work horribly when the market is range bound, generating all kinds of whipsaw signals. You need an indicator that can cope with both market environments, both ranging and trending, and that's where beta sine wave comes in. It's the only indicator I know that shows you the support and resistance levels when in a ranging market, and then once the market breaks out into a trend, shows you where the trend is likely to end. So again, looking at this E-mini chart, price breaks support here into a downtrend, and then signals a pullback to end of trend when the trend move is over. Again, the indicator is just using price, and these are real-time signals. There's no back plotting or funny business going on. It's the best price-based indicator I've ever found, and really it's only possible because of the increase in computational power that we have with modern computers. So that's the final part of the puzzle, a high-tech price-based indicator. And when you put all three indicators together, you get high probability trading signals. Remember, each of these indicators is analyzing a different data point. Beta proam is analyzing average trade size and showing professionals buying here at the lows. Then beta momentum is showing we've got less selling going on, and finally flushing out the last of the sellers with this flush signal here. And lastly, beta sine wave signals the end of the trend at the same point. So the three indicators measuring totally different data, they're non-correlated, and when the signals converge, that's when you get a high probability trade. Now, not every trade is this picture perfect, but using the three non-correlated indicators and ditching your half-dozen price-based indicators will definitely improve your trading. Together, the three better indicators give me a fuller picture of what's happening in the market and when a change in trend is likely to take place. So that's the three indicators. Let me answer 4 frequently asked questions, and I'll run through these quickly. Do the indicators just work on the E-mini? No. They work on all markets as long as there is volume data, and that includes Forex futures. Next question. Are the indicators optimized for the E-mini? Absolutely not. In fact, there are no inputs to optimize. The indicators are dynamic and they adjust to each market or time frame you put them on. Remember, I'm a trader too, and I hate optimized indicators, and I really hate indicators that backplot. So there's nothing like that happening with any of the better indicators. Third question, what platforms are the indicators available for? And the answer is TradeStation, NinjaTrader, and MultiCharts. They're 3 of the most popular trading platforms, and that's why I've chosen to support them. Lastly, why are they called the better indicators? Well, that's because they would not have been possible without the work of some real geniuses, particularly John Ehlers, Tom Williams, and Richard Wyckoff. All I've done is move the ball forward and improve on existing indicators and concepts. So from my perspective, they're just better. They're not ultimate indicators, they're better indicators. So thank you for listening. I hope that helps explain what makes Emini-Watch different. Feel free to explore the website by clicking the links above, and in particular, check out the trading blog where I'm always adding real-time trading videos and useful advice for traders. And I wish you good luck with your trading.